Good afternoon, everyone, and welcome. Welcome to our professional development offering this afternoon. I am, of course, Jim Howe, your FEI president for this year. If I haven't mentioned that before, so glad to be here, so glad all of you are here. Today we're going to have what has almost become a traditional February offering with our title sponsor, KPMG, an accounting and tax update, which we are greatly appreciative of, and it just also gives me another opportunity to thank all of our sponsors, but especially today since we are highlighting KPMG and what they bring to us. And on the stage with me right now is Michael Nesta, who happens to be the Dallas office representative to our board and attends our board meetings and is very involved in FEI. You've seen him around, you love him, you know him. You may not have met him. Please do reach out and greet Michael. We're fortunate not only to have him as the KPMG representative to FEI, but we're fortunate to have him put this together for us, which is a great offering to the membership. And we're also fortunate to have him in our market and available to us as professionals. He is a partner and leader in the accounting advisory services for KPMG US. His areas of focus include financial instruments and securitizations, business combinations, stock-based compensation, revenue recognition, debt and equity structures, consolidations, and investments. And he's a proud graduate of both his bachelor's and master's from the University of Texas at Austin, who fell to the Arkansas Razorbacks this year in football, I believe. Anyway, Michael is a great resource. He's a great contributor to FEI. And if you want the link to his profile, I'll be happy to send it to you. Michael, I'm going to turn it over to you.
Great. Thanks, Jim. Thank you so much for being here. We do have a good program today. I'll introduce Noel in a second, but do want to send our thanks in advance, for your attention during our presentation, and maybe your grace, as this is the first in-person presentation that the four of us have done in probably over 2 years, so we're probably a little rusty in working the room and those sorts of things. So, but it is, some people say the Masters is a tradition unlike any other, but to me this February meeting is, I was telling them I've got PowerPoints by year going back from 2022 down to 2012. So this has been something that I've done and been a part of for a long time. And I will make the Texas joke for you that even going back that far, we're still another 6 years away from our most recent national championship. So it has been quite some time since I've been doing this. But again, really, we appreciate it. We look forward to it. And thanks again for being here. So our program today is going to be a mix of kind of working from home update with a tax element to it. We're going to have an update on the Biden tax agenda. Mike Fishman will talk about an issue that related to the R&D tax credit and that regime that I think affects a lot of companies that have a number of different development activities. And then I'll close it out with kind of an accounting GAAP, ESG briefly update, and then once I've depressed you when I talk about ESG, it'll be time to go to the bar. So we've timed it out and sequenced it out perfectly. So with that, bring up Noel Ellison, a tax partner from our office, focuses on mobility issues for employees of multinational corporations, but certainly over the last couple of years has been kind of at the fore of focusing on broader issues of our employees and our clients' employees working from home and kind of the complexities and opportunities that present. So with that, Noel.
Great. Hi. Well, welcome everybody. I'm happy to be on stage. It is over 2 years since I've been in front of a live audience. I think I spoke to you all about a year ago, but it was virtual, and all I think of is being virtual, sitting at my desk. I've got my cup of water, I have my stretchy pants on, and my house shoes and slippers when I'm doing most presentations. So I'm trying to make sure I don't fall off the stage or anything. And I was surprised. I thought, gosh, this would be a much better room if everybody had a drink in their hand. Kind of get us get us loosened up and getting silly about accounting. But what I want to talk about today is doing a refresh on this flexibility of work arrangement that we can't stick our head in the sand about anymore, and kind of give you an update to where we've come from kind of in this journey the last couple of years. So as Michael said, I'm a tax partner in our Dallas office. I do specialize in global mobility, which means that if you guys are sending employees across a border, whether it's a state border or an international border, you come to me. I help work out policy issues, tax issues, keep the business happy, keep employees happy, and help keep the business compliant. And so this is kind of our latest challenge, this idea of remote work, flexible work. Where are my employees? What are they doing? Are they creating permanent establishment issues for us? And so, I've had a lot of conversations with organizations that are talking about, or at the outset of the pandemic, thinking, we're just going to take a 6-minute pause and then we'll all be back in the office, business as usual. And these organizations who have really wanted to hold on to their roots and culture of being in the office have had to bend and accept that going back to the new normal is just not going to happen, whether it's COVID and the ping-ponging of home and work and back in the office and not, or now with the Great Resignation kind of at our footstep, trying to retain talent and keep everybody happy. So the first question I typically get is, Noelle, what are you seeing in the marketplace? And the answer is, I'm seeing everything. And there is no consistent policy across an industry or a geography or an employee population. And really what that means is when you call your buddy and say, hey, can you send me your policy on remote work? That's great. I don't want to discourage you from doing that. I think it's a good starting point. But I think what you'll find is when you sit down with your stakeholders, it's all going to go out the window, and you're going to be left to developing your own policy at the anyway. So smaller organizations who ideologically might be more prone or to thinking, okay, we can be flexible, we're new generation, we're not too big, it should be something we can handle. The issue with smaller companies is maybe they only have a footprint in 3 or 4 states, and their employee wants to work remote from a state that's not one of those 4. So then a company that might have internal resources that are already stretched is left trying to figure out, well, where is this employee? Now do we have to do a corporate filing in this 5th state just for one employee? Are they creating a legal presence for us in that state? How do we get payroll taxes in? And so on. Larger organizations, it might be a little bit easier for them to adapt. They might have a broader footprint around the globe, but at the same time, it might open the floodgates and be harder for them to track. So sometimes maybe we start with a little bit of a definition. Historically, we were dealing with business travelers thinking that they were the enemy. The guys that get on an airplane and, on a whim, they're just off working in New York City and then off to California and then off to Canada. And it was like, how do we find them? Where do we do? Do we need to report? What are we going to? And then now that we have these remote workers who just up and start logging in from their vacation property in Colorado or Utah, we realized that the business travelers were easy because at least they were leaving a footprint of an expense report, corporate travel, meals and entertainment receipts that designate their location. These remote workers, they blur their screen. You don't know where they're calling in from. It may be the beach or the pool or Vegas or who knows, which isn't a bad thing. It's just one interesting way a company that I know went to find out where their employees really were is they said, hey, we had a great quarter, want to send you a gift, let us know where we should send it. And then everybody came back with an address, and they realized there was a mismatch between where they said their resident state was and where they wanted the gift shipped. So it just kind of shined a light on the organization that even though maybe they don't know, that they should know, and there's a risk out there. And all we're trying to do with these policies is figure out, what is your risk profile and kind of where do you want to be on that pendulum? So, developing a policy around flexible work is key. Not having a policy really lets the inmates run the asylum. And it creates patterns in organizations where a department head might say, guys, if you need to work from home Mondays and Fridays, no big deal with me. We can do this globally. We're a virtual team anyway. We've got people in EMEA and Asia Pac. Let's just work remotely. That can tend to create dissonance across the organization when the people in another department say, well, you're letting them work from home 2 days a week. What? So, wanting that consistency there is important. Having a policy is important. Stating what that policy broadly is even as important. There are probably 3 lenses that you'll want to take a look at as you develop your policy. One of the lenses is through the people lens, of course. What are your people doing? Where do they want to work from? Is it possible to work from another location? Can the business support it, or do they really need to be in the office for whatever reason? Some companies might want to push their employees out of an office because, the cost is going to be a lot less. The footprint, they can do hot desking and save some money on real estate costs, downsizing. Or not have as big as an office maybe in New York City and let people come in through different locations. The second lens is the point of view of your HR system, meaning what should we allow our employees to do? What's good for the business? How's it going to impact compensation? If we hired somebody in New York, but now they're living in Utah, should they be on the same pay scale as somebody in New York or as somebody in Utah? What's your expense policy going to look like? So if the job is in Dallas-Fort Worth, you've got somebody in Kansas that wants to live and work remotely from Kansas City, who pays for the airfare for them to come to an all-hands meeting in Dallas? Is that on the shoulders of the employee, or is it on the shoulders of the business? Other expense considerations, paying for internet, paying for computer peripherals and other things. And just making sure that there's clarity in that and a policy that addresses some of those topics. And then the third lens is really technology. And technology is going to be kind of at the heart of it. Now, technology, of course, has evolved significantly. I love this remote work from the perspective that I get to see colleagues in global offices for KPMG that I've worked with for 20 years but never really knew what they looked like, and now we're screen to screen and really comfortable with being in front of a camera with each other. And so technology's kind of caught up to allow us to work remotely in a lot of different ways. I love it too, because I can go for a walk in the middle of the day and be on a Teams call and just kind of sit in the background plugged in, which is kind of nice. It's something I couldn't do before. But beyond that, once you do have a policy for remote work, how does your technology within the organization support you in that? So does it allow you to identify where your employees are working? Do you have an HRIS system that can track, this is where I live, this is where I work, this is where I work for 3 months, 6 months, 2 months. How do you track where your employees are? Do you have the technology that allows somebody to submit a request for remote work? And where do you track that? Where does that request and approval get housed? And then, so how does your system know if somebody actually is working in Utah or Idaho or wherever they may decide to work from? Or overseas, so that you can communicate and know where your employees are, even from a safety perspective. And how do you transact the payroll reporting for that employee? How do they account to you for every day that they're working in another jurisdiction? So technology really is the surrounding basis for all of this. I think what we've seen too is that most companies will assemble a committee of cross-functional stakeholders. That's best practice, without a doubt. You don't just want, if you ask HR, HR is like, let them work where they want. We want happy employees. We want no turnover. We don't want the great resignation. If you ask tax and finance, they're like, too complex. Let's just get back in the office, right? So you really need a blend of individuals who represent all of your different areas of your business to help make those decisions and pull it all together. Your policy that you develop is going to be bounded by the risk that you're comfortable with. We all know that there's risk in everything that we do. 100% compliance is an impossible goal, but not being compliant is not enviable either. So, you guys will be familiar with this. Most of the risk items here, 4 of those buckets are tax: individual tax, corporate tax, GST, and figuring out how your remote workforce impacts each of these buckets of tax. The other items of risk to consider, equally important: reputational risk, how you're going to, what your workforce is doing, your business continuity, all of those things. And so those will be, considering risk through all aspects of developing your policy is going to be key. Once you have your policy, that's great. Your policy is going to say, yep, it's okay if somebody goes and spends up to 14 days working in this jurisdiction, but on day 15, we need to start reporting. Reporting payroll, withholding taxes. How do you get that done? How do you know where your employee is? When do they trigger it? What's the matrix that tells you, well, do we report day 15 wages and up? Do we report day 1 wages through the entire time? And is it all states? Is it some states? Is it, so it's after you've decided what your policy is going to be, it's time to operationalize it, making sure that you can create a process within your organization. Let the request go to HR to ask for remote work flexibility, approve it, then decide how you're going to interact with tax to make sure that that is okay to approve. And how does your process flow? Reporting time, letting that flow through payroll, and so forth. So these are just high-level examples, but certainly it's a complex process, and I think what companies are trying to do is say, let's just get started. We'll work through this. We'll have version 1.0, 1.5, 1.6, and get better and better with the reporting side of things as you go. So, got through that pretty quickly, but I will be here, lots to think about. I will be here for the rest of the evening, and we'll be networking with you guys. So if any questions come up, more than happy to address them. Thanks.
You can ask.
Hello, everyone. My name is Andrew Brannon. I'm a managing director in tax, and I am. Let's see if I can work this here. Oh, it's not going the correct way. Green button. There we go. And I am in the BTS group for here in Dallas, and I am going to give an update on the Biden tax agenda. And while I am in tax, and I do enjoy tax, I promise to keep the code section references to an absolute minimum, because I'm sure nobody really wants to, memorize every code section out there. So, so the Biden tax agenda, you may have actually heard this called the Build Back Better Act, as we call it now. It's been in progress basically the entirety of 2021, and it's looked quite a bit. It's looked different throughout as 2021 has gone along. It was something north of $3 trillion of spending, which has kept getting tapered and tapered and tapered, and finally, in November of 2021, the House finally came to an agreement and came together with a bill that they could all agree upon and pass upon to the Senate, which, as you know, in the Senate, it's 50-50 Republican, Democrats, so they needed unilateral support from the Democrats in order to pass the bill in the Senate and to send it to the president's desk, with the VP vote being the tiebreaker. And Joe Manchin effectively shot that down in the month of December. So, yeah, I'll take that applause for me, but we'll keep going. So what did we learn from 2021? I mean, there's been so much back and forth of negotiations in the House and Senate. It almost kind of feels like a lost year, because the push was really to get something pushed in 2021. So the question really is, well, what now? I mean, is the Build Back Better Act, is that done for good, or is that something that still has life? And as all things in tax law being no different, it's not clear. So what you see before you here is a brief summary of what the spend and the revenue raisers are looking like for the year and for the bill in its current form. It is clear that Biden he definitely wants to get something done over the next several months, but how closely it looks to what you see up here on the screen, I think it's pretty likely that it's going to be a much more slimmed down version of what you see kind of up here on the screen. So where do we go from here? I think as you can tell, there's quite a few revenue items on here. Namely, the revenue is less than the spend here, which is a big problem. So what they're going to have to do is they're really going to have to focus on areas that really has just unilateral support across party lines. And it's they could split this thing up into multiple bills, but if history has anything to say about that, it's usually there's usually a reason why these kind of big tax reform changes like this come in a big package, because it takes a lot of negotiations to get there. So somebody's not going to get their fair cut. So I think it's probably pretty likely where our national folks have kind of who have their ear to the ground have kind of indicated that most likely we're going to see one big slimmed down version of the bill, and that may be it. So there's going to be a mad rush to get everybody whose agenda they're going to want to get it in that first bill, because everybody, I think, kind of knows in the back of their head there's not going to be a second bill. So where do we go from here? I mean, this is what the bill looks like in its current state, which, if we, just to kind of level set what some of the items are in the bill, and this is by no means an exhaustive list of what's in the bill, but these are some of the really kind of core items, I would say. And the first one at the very top of the list, which you'll notice is actually not a change at all, which for the longest time during 2021, we thought there was going to be a change to the corporate income tax rate. However, the version that passed the House indicated that there was basically no raise in the corporate income tax rate, cap gains rate, or ordinary rates. So as a tax professional who does a lot of accounting for income taxes, I was very glad to see that the rate did not change 7 days before year end, like we experienced a few years ago with the TCJA Act, where we had to remeasure deferred taxes right at the end of the year. So I personally, that got my vote of approval, that's for sure. But earlier in the year, they were looking somewhere in the realm of anywhere between 25, 26, 27%. So that in the current bill, that stayed put at 21%. The one area that was maybe a little bit of a surprise was this corporate minimum tax, which of all the items here on this listing here, you can see at the very top of the list there's $320 billion is what this one is intended to raise, which is about the largest one on this list. So if the spending goes down, then the revenue raised from tax increases is likely going to go down as well. I doubt that Congress is going to pass something which is a deficit reduction bill, which I don't think has happened in something like, I don't even know. I couldn't even tell you. So, but of all the raisers within this listing, this is probably the one that will that our kind of folks in Washington are thinking that might get struck first, because it is a big revenue driver. And it's a little bit novel in its concept and how it's pulled together, because it's a flat taxation for 15% for certain corporations which have revenues in excess of $1 billion over a certain amount of time. I won't go into the exact, as it's written, because who knows, it could change tomorrow for all I know. But the point is, though, it's a bit novel in just that there's not a lot of areas within the corporate tax realm which just focuses straight on a flat, earnings times 15%, because what if it's different types of, whether it's US GAAP or IFRS, or, there's a lot of different kind of iterations. And it's just not something that's been really done a whole lot. I mean, there has been an AMT tax in the past, prior to when the TCJA abolished it, but it was a lot more grounded in kind of your normal tax law, I would call it, where it's based off of some measure of, the tax code. So this one is probably one that will get struck. The next one is probably on the opposite end of the spectrum, where tax on foreign earnings. This is an area where not really a lot of people on either side of the aisle have pushed back on a whole lot. And this also happens to be probably the most complicated area within the bill. So whether or not everybody fully understands all the calculations that go into it, that may be a TBD. But in short, I think it makes sense to maybe just talk just a brief amount about kind of what this means, and because you can see here it says the rate increase will go from 10.5% to 15%, and you might be thinking, well, is it the tax rate 21%? Why are they talking about 10.5%? Well, under the old, under the TCJA, they made a lot of changes in the international tax area, one of which was around what we call as GILTI tax. And the summarized version of what GILTI means is, in lieu of having to wait to bring cash back from your controlled foreign corps, where that was typically the event which would cause you to pay tax in the U.S. In lieu of that, they came up with this GILTI regime, which effectively looked at all of your foreign earnings at the CFC levels and passed it up with some, calculation on rate of return on assets in the foreign jurisdiction. And based off of that, you were able to come up with some proxy taxable income calculation in the foreign jurisdictions. And then on top of that, there was this other, and I promise I won't say too many code sections, but the Section 250 deduction is what it's called. But effectively what that allowed for is it would allow you to look at your GILTI taxable income as it was calculated, and you would generally be able to get some amount of 250 deduction, which had its own set of limits. And effectively, it kind of gets you down to about 10.5%, which is half of the 21% corporate rate. So the new guidance that's coming out with in the Build Back Better as it's written currently is effectively limiting that 250 deduction, so that in lieu of getting a 10.5% effective rate, it really brings you back to maybe like a 15% on your foreign earnings. Now again, there's a ton of stuff in that provision, and I will spare you the details, but high level, that's how you can kind of view that. It'll increase tax in foreign earnings. Next one is a stock buyback, which is it's basically a 1% excise tax on stock buybacks. So primarily publicly traded corps, and there are some specific rules on what you can net within that. So if you buy back stock, but then maybe you issue new stock to employees via share-based comp or something of that nature, that you can net the two when calculating the excise tax amount. Next one, the interest limitation. And this one was a little bit surprising, I thought, to me, because within the TCJA, just a few years back, they implemented what we call the 163J limitation, and it basically it was a little bit punitive, particularly now, because it was a mechanism for which you could calculate what your adjusted taxable income would be, and then there's some percentage of that you'd be allowed as a deduction, depending on how much taxable income you had. And it phased out, and to get to the adjusted taxable income amount, you would have to add back depreciation expense, which sunsets actually in the year 2022. So in the year 2022, it becomes a lot more difficult to deduct interest, particularly for a company that's highly leveraged or has a capital a CapEx intensive structure, which generates a lot of depreciation deductions. So this is actually in addition to that regime, which came out just a few years ago. And the way that the limitations work, it's the new law is some mechanism which takes foreign earnings to U.S. taxable income and comes up with some leverage ratio to figure out how much interest would be deductible in the U.S. And what you ultimately end up having to do is you have to look at both the old regime and the new regime and pick the more punitive of the two, and that's the amount of interest that gets disallowed as a deduction. So that one was a little bit surprising, I thought, but that is again, none of this is law, so this is all just proposed, but I thought that was a bit surprising. Next one down, surtax on high earners. This one's a little bit sneaky, I feel like, because it does add a new 5% income tax surcharge for folks. I believe it's in north of the $10 million MAGI threshold, so your high earners. But where this really gets, I think, is the real revenue raiser is the impact that it has on estates. So while the surtax is for modified AGI above 10 million for folks that are married filing jointly, the threshold for estates is only 200,000. So you just think of all the estates that are out there that are probably north of 200,000. That's where the real revenue driver comes into play. And I think this one's a bit of a sneaky one that they kind of slipped in there. So whether or not it'll stick, it'll TBD. Next on the list is one that I know is actually, you notice the arrow going down, which is a good thing, right? Meaning in lieu of tax raising, that's actually a tax benefit for the people out there. But it particularly is impactful for if you live in a state with a high state income tax, like New York or California, because under the current TCJA law changes that came out, you're limited to deducting state and local taxes up to $10,000 per year, which, if you're in a state income tax paying state, that doesn't go too far, nor Texas with property tax for that matter. But under the new proposed law, that gets changed from $10,000 to $80,000. What I found interesting is they proposed it to begin in 2021 to 2030. That reverts back to $10,000 in the last year, but so I chalked that up to they're using a 10-year timeline and they needed some money at the very end, so they said, well, just cut off the last year and call it a day. And then the last is renewable energy. So renewable energy, a lot of this was already in place, and I personally have a few clients who have invested in some of these vehicles, but it's more just the incentive around to get investment into renewable energy. And a lot of this in the bill is just an extension of what was already presented and what was already out there, because a lot of that was set to sunset over the next couple of years or so. So this kind of puts that back into play. So next slide here. So the last slide that I just went over is effectively everything that's in the highlights of what's in the Build Back Better Act that went to the Senate. So what you see up here might be a little hard to read, but these are actual enacted changes today, which I've mentioned a few times that there may be some things that are sunsetting over time. And one of which is the 163J interest limit that I mentioned before, where it's now changing to a regime where you can't add back depreciation to get to your adjusted taxable income, which in effect lowers the amount of interest you can deduct. And the second is around research and development expenditures, which Mike's going to talk about in depth here, which is in effect enacted law for 2022. So for both of these, this is something that's here now, and it's something that'll need to be addressed. So what is the timing of all this? Well, this is the 2022 calendar, and as you can see, there's not a whole lot of dates on the calendar. The most up-and-coming relevant date, I would say, is this 2/18 government funding date that Congress is going to have to meet to avoid another government shutdown. So they're going to be talking about budgeting and reconciliation and what have you. So it's inevitably the Build Back Better Act and its provisions are going to come up as part of that. And immediately thereafter is President Biden's State of the Union address on March 1st, which I'm sure he would be very keen on going to the State of the Union and indicating that, the Build Back Better Act is back on track, and to show that progress has been made by that date. So I think those are two pretty key dates to think about. And then the next is the August recess, which, if history shows, not a whole lot gets accomplished before the August recess. So it really seems like the next month or so is going to be a really critical time if there's anything that really is to be passed, as I'll call it the remnants of the Build Back Better Act. And then after that, you've got elections, and then all bets are off. So very limited amount of time to get anything done over the next several months. So whether or not we'll see something, your guess is as good as mine. I think we'll probably see something, but it's going to look, I think, a lot different than what we saw up on the screen for what's currently the bill that went to the Senate and didn't pass. So along with that, I'll turn it over to Mike, and he's going to talk a little bit more about R&E expenses and mandatory capitalization.
Thank you, Andrew. So when Mike reached out to the tax practice and asked if we had any relevant topics to talk about, I said, yeah, I'd like to do an hour on R&D. And the question came back, well, maybe some other topics too. I said, okay, I can do 30 minutes on R&D. Well, we're going to have Noel talk about this, and Andrew can cover legislative update. We'll give you 5 minutes. This could be an hour presentation. I'm just going to leave this one slide up here while I talk. I also told Mike I was going to do some political commentary here. He told me I should lean one direction versus the other. I'll let you guess what his advice was. But no, I'm going to be an equal opportunity offender here. So let me frame the issue. So when the Tax Cut and Jobs Act, the TCJA that Andrew referred to before, when that act was passed back in 2017, they used the budget reconciliation mechanism. If you've watched any news during that time or recently, you understand what that means, that they can stuff that through Congress with a pure majority vote. They don't need the plurality vote. That's what the Republicans did in 2017 with no Democratic support. In order to use reconciliation, it has to be revenue neutral over a 10-year period. That is very hard to accomplish, so you have to pay for it. So one of the gimmicks that they used back in 2017 to pay for it was they said, well, if we put capitalization of R&D costs into the law, that raises a lot of money, but it's terrible policy. Why would you ever want to make companies capitalize their R&D spend, right? That's exactly opposite of what you want to incentivize. You want to incentivize R&D, particularly in the US. So they put in a 5-year amortization for domestic R&D and 15-year for anything that's offshore. But they put a deferred effective date in because they said it's such bad policy, some future Congress will come along and fix this, right? This will never become law. In fact, we hired some of the people that were in the room when this law was written. Everybody understood this would never become law back in 2017 when it went into the law. Guess what? The deferred effective date was for years beginning after December 31st, 2021. So if you're a calendar year company, this applies to you now. And I'm going to venture a guess, this applies to every single person in the room. And you might say, really? Every single person? Somebody will say, well, I work for a nonprofit or I work for a government agency. Okay, maybe it doesn't apply to you. If you work for a for-profit business, this applies to you. So to the extent you have R&D costs, the law of the land from where we sit right now is mandatory capitalization. So the Build Back Better Act that Andrew referred to, that actually included a provision. This is where I get to be an equal opportunity offender. The Democrats knew that capitalization of R&D is also terrible policy. And in fact, this is one of the most bipartisan things in Congress right now. Everybody understands it's terrible policy. Nobody actually wants this to be the law because it's a disincentive for R&D. But the Democrats also needed to pay for the Build Back Better Act. So repealing that provision just cost way too much money. So what did they do? They put in a deferral. So instead of repealing it, they said, well, we'll just defer it for a few years, kick the can down the road. So that's what's actually in the Build Back Better, which Build Back Better is probably on life support at best, possibly dead. So then you'd say, okay, so if Build Back Better doesn't happen, does that mean we actually are stuck with this mandatory capitalization? Yeah, unless Congress fixes it somewhere else. So where's the somewhere else? Well, the timeline that Andrew put up there, if it doesn't happen very soon, it's probably not going to happen until we get an extenders package at the end of the year in the lame duck session of Congress. So that means for anybody that's a publicly traded company, as you're having to issue your quarterly financial statements, you're going to have the law that says we have this mandatory capitalization. You're going to have to report, because that is the law. You can't report based on what you expect it to be. So you're going to have to report with mandatory capitalization, knowing that probably by the end of the year, Congress will retroactively extend the current deduction back to the way it was. Okay, so is this just a timing item? That's a question I get a lot, right? So what you're telling me is instead of a current deduction, I just need to capitalize it. That's not great. That could cost me some estimated taxes and whatnot, but is it just a timing item? If only we were so lucky. So Section 174, the tax code section that covers R&D expensing, feeds into a whole bunch of other provisions. So if you have international operations, if you claim a foreign tax credit, you mentioned the GILTI provisions, the BEAT, which is part of the 2017 Tax Act, if you have interest limitations, all of those are affected by your R&D deduction, and it's entirely possible are going to have permanent effects, not just timing effects. So this is a mess. This is a mess for reporting through the quarters. It's a mess from a standpoint of determining your estimated tax payments throughout the year. Do I expect that by the end of the year Congress will fix this? It's a who knows, it's a guess, but I would say yeah, because everybody agrees, both political parties agree, we do not want to have a capitalization of R&D costs. There is an impact on the research credit as well. I know, Mike, you had mentioned the research credit when we teed this up. In the past, companies may have treated costs one way or the other. You actually now must, in order to claim a credit, treat it as one of these R&D costs that is capitalized. So if your company claims an R&D credit, you must take this mandatory capitalization into account. Otherwise, you won't be able to get a credit. So that's an important nuance. Now, I quite literally, I wasn't joking. I could go on for an hour on this topic. I promised Mike I'd take 5 minutes. I think I've used my 5 minutes, but I will be here, as Noel said. I'll be here during the cocktail hour and the evening reception. Happy to take any one-off questions either now or then. Every single one of the items up here on the screen, this kind of holistic view, every one of these is a critical item. So I will leave it there, Mike. I don't know that I could do any more justice in 5 minutes. Yeah, any questions now, or happy to? I got a question over here.
Yeah, speak loud.
Yeah, I can hear you.
A quick question, is it essentially the same activities that previously were captured and qualified for the R&D tax credit, now get capitalized, and that's only for tax purposes, not book, is that right?
So nothing to do with book, that's exactly right. It won't change your book, but I'm glad you asked the question. So that's that top upper right-hand spoke, if you want to call it spoke, that you're referring to. The question was, if you couldn't hear it over here, is it the same expenses that we're talking about for your research credit that we're talking about for the deduction? This is my analogy. If you think of a pizza, the research credit is about 3 slices of your pizza. Section 174, the deduction is the whole pizza. So what do I mean by that? To qualify for the research credit, we have a test, 4 tests or 7 tests if it's internal use software. For Section 174, for the deduction, those tests don't exist, so it's much more expansive. There can be a lot of activities that you'd say, this is just routine development. We're not really doing anything, new or improved. It's just routine development. It's still R&D from a deduction standpoint. Anything that's foreign-based, meaning outside the United States, that would be part of this deduction criteria, whereas that would be excluded right off the top for the research credit. From an expense standpoint, the research credit only includes the wages, the supplies, and any contractor costs. That's the only 3 expenditures that qualify for the credit. For the deduction, it's all your expenditures, so your fringe benefits, your overheads, your depreciation, utilities, rent, so much more expansive. So again, think of your research credit, which everybody, not everybody, but most people are probably familiar with. Again, that's really only 3 slices of the pizza. So there's a fairly significant lift here to get ready for this. And, you know, I realize I'm not generally speaking to a tax audience here, but this matters to Treasury and Finance a lot, because from a Treasury standpoint, I was on a call today with a company who will have to capitalize and amortize about $90 million of costs. So the difference between current deduction and now having to make estimated tax payments with an additional $90 million of taxable income, that's a big deal, right? And from a CFO controller standpoint, you're gonna wanna know about that, and that is coming, right? Expect that conversation. If you haven't had that conversation with your tax department, if you get nothing else out of today's session, I'd go back and say, okay, so what does this mandatory R&D capitalization do to us? You bet. Any other questions? It's a great question. Okay.
Excuse me. Thanks, Mike. So the last portion of this will be kind of focused on GAAP financial reporting matters. As some of you are at year end, or hopefully if you're public, you're hitting the home stretch on year end. For private companies, I know that you've got a bit more time. So, kind of what I'll say kind of at a macro level is, before we get into the details, from a macro level for financial reporting, so we had RevRec, we had leasing, we had CECL, we had these big bang projects. And so since those have come out, the pendulum's shifted again, where we had these big projects, a ton of work, a ton of implementation time, a lot of consultant time. And now the pendulum, is kind of going back the other way, where the FASB is kind of in a death by 1,000 paper cuts type notion, where there's a lot of very small projects. None of them are very pervasive in and of themselves. Most of them may not apply to you, but there's probably 1 or 2 that's going to require some work, and I've tried to highlight in these slides where I think there's some changes that might impact a decent amount of you. But I think the good news, certainly from a private company, we are in a world now where the FASB for a long time, has had this private company council, and I know we have a lot of private companies represented here. The FASB has had a private company council, and over the last decade, they've issued a number of private company exceptions that have significantly simplified the reporting burden on private companies. And so, I think that's been, from a private company preparer perspective, has been a very good thing. What we've seen, though, in connection with the recent SPAC IPO boom is a number of companies that never thought in a million years they'd ever go public are now, maybe not over the last month, but certainly in 2021, with very frothy valuations and market multiples, a number of private equity investors have said, how we said, don't worry about getting a PCAOB audit, we're going to be private forever, we'll sell you to another private equity firm. Yeah, that's changed, and I need you to be ready to go public in 3 months. Well, that means we're now undoing all of these private company exceptions that have been out there. So I always say, private company exceptions are benefits to preparers, but you also need to realize that a number of them, other than like deferred adoption dates, which you can apply if you're an emerging growth company, if you ever go public, a lot of these simplifications, like amortizing goodwill being the biggest, the minute you go public, that needs to be reversed, and you need to go back and do goodwill impairment tests for as long as you've been amortizing goodwill, and that creates a significant roadblock to market timing in a lot of these cases. So again, private company exception is very good, but just be careful with them and understand where they exist and understand, the risk that might come with that down the road. Beyond that, but on, the other good thing about some of these private company exceptions has been, and I don't have a slide on it, but just, kind of where the FASB's headed. It's, some of these private company exceptions, there's been some investor feedback that says, I know you're doing this just for private investors, but as a public investor, I don't care about this either. And we don't care from a public company perspective. And the biggest one is goodwill amortization. So speaking of a pendulum, 20 years ago, the FASB said, thou shalt not amortize goodwill. We think it needs, that doesn't make any sense. Goodwill's, a perpetual asset, and unless it's impaired, we think it should stay there. Well, 20 years later, they're now exploring amortizing goodwill again, undoing a lot of the reporting unit analysis and complexity that comes with it. There's a project on the agenda to do it. And so, what's old is new again. And so, that's the other part of some of these private company exceptions is it's, awoken folks to say, well, maybe we should make those rules apply to public companies as well. If it's, what's good for the goose is good for the gander. So where are we right now, kind of year end? Issues that we're seeing. One is a reminder, we have kicked the can as far as humanly possible, but there is no further deferral on the lease accounting standard. So if you are a private company or you are a public company that applies private company adoption dates, time is up. 1/1/22 for calendar year companies, you need to start applying the lease accounting standard. For a lot of you that only do financials once a year, that still gives you plenty of runway till next year. But just know that the FASB met in November, the question was asked and answered. They are not going to defer the effective date any longer. So not going to belabor. I'm sick of talking about it, you're sick of hearing about it. I've talked about it almost as far back as 2012 about the lease standard. But again, the main point is, the main thing you should expect from your auditors if you have not adopted the standard is completeness. How did you capture all of the leases? How did you make sure what exists you've captured? Otherwise, your balance sheet will be misstated. So going through, looking at how you spend, talking to your IT department, talking to your real estate team, talking to whoever manages supply chain procurement, et cetera. Those exercises will be important as you go through adoption. But the good news is that 3 years on, there's a lot of lessons learned that you can draw from other companies, from advisors, et cetera, to hopefully make the process more efficient. There is a lot of relatively inexpensive technology, software packages, et cetera, that you can use to operationalize the accounting because it's not straightforward in terms of how you run out these assets and liabilities. So be mindful of that. The other kind of thing that is more, accounting is just a reflection of what's going on in the broader marketplace. So what's going on in the broader marketplace is that LIBOR is dead or is about to die. So basically, banks are being incented and will be punished if they are not issuing non-LIBOR-based products. Products that use LIBOR are being sunset, and for certainly the big banks, all new products that they issue needs to have a provision that kicks in when LIBOR is sunset in later this year. And so, what's going on with that? Again, it's from an SEC perspective, the focus is, for a lot of companies in here, you're not issuers of, you are issuers of debt, but you're not offering, various products to your customers as an investment bank or a broader bank might. So it's less, it's going to be around how did you identify all of your different LIBOR-based products? Hopefully that's a relatively straightforward exercise. What is the transition provision in your debt agreement that kicks in upon the sunsetting of LIBOR? For debt instruments that are, older than a year or two, a lot of what I see is it doesn't really contemplate it, or there's a default provision that kicks in that goes back to Fed funds rate, which is not necessarily where where a lot of you want to be. So I think understanding what provisions exist and how they kick in and what's going to happen. Same thing with any hedging instruments you have. How are those going to be dealt with? What provisions kick in under your swap agreements with your banks if you're hedging fixed to floating, floating to fixed? That's the big, what I'll say, treasury commercial exercise. The FASB's responded in providing, an accounting standard and really a couple of additional standards that basically provide some level of flexibility that says if you have, if your debt agreement is impacted by this, or you don't have to evaluate whether it's a debt modification and go through that whole rigmarole of analysis to say, is my debt modified or extinguished? If your hedging relationship is broken because the interest rate, the reference interest rate has changed, there's an exception such that you don't necessarily have to break and fail hedge accounting just because you've moved from LIBOR to what's primarily going to be SOFR, the Secured Overnights Funding Rate. If you have to move from one benchmark rate to another, you don't automatically fail hedge accounting. There's a number of those expedients that they've put in there to try to simplify some of the pain that might come along with the changes to these instruments. So that's kind of at a macro level, with LIBOR going away, there is an accounting consequence, but maybe a broader commercial consequence that the folks in this room as financial executives should be preparing for as you go through the year, because they will stop publishing LIBOR primarily by the end of this year. Now getting into some more of the narrow accounting changes that you should be mindful of. So this first one applies to private companies only, but we see this a lot where you might get a 409A study done to evaluate the fair value of the company for income tax purposes when you issue options or restricted units. There are always questions that auditors might raise around, yes, you did a 409A study, but that's for income tax purposes, and did you consider the GAAP definition of fair value when you went through that exercise? And it's not uncommon for a lot of companies that are private to have to do two separate valuation exercises, one for GAAP, one for income tax purposes. And so basically, what this is trying to do is basically permitting you to use a 409A study or analysis as a proxy for GAAP fair value if you are a private company, so you don't have to run the exercise twice. There's a few parameters. It's supposed to be a reasonable application, but basically it points to a 409A study as being that. So trying to make it easier, again, private company exception, something that would have to be reevaluated if you went public, but from a private company perspective, trying to simplify the analysis and the accounting around issuances of share-based payments to employees. And then it can be adopted. It's effective for calendar year companies 1/1/22, but if you haven't issued your financials, obviously for 21, you could do it for your calendar year 21 as well. This next one does apply for acquisitive companies, and and I say this as somebody that spent my first year of my career at the FASB, and it's one of those things where the FASB goes through cycles of what it believes to be, going through a very theoretical view of the world back to a more practical, pragmatic view of the world. So just as I said earlier, the theoretical FASB 20 years ago said, thou shalt not amortize goodwill. That doesn't make any sense. This is an asset that continues to hold value and could be in perpetuity. And then they're looking to change that 20 years later. This is another thing. There was an EITF issued 20 years ago that basically said, if you buy a business and that business has deferred revenue, so we see this a lot in subscription-based businesses. So customer prepays for a year of service, and halfway through the year it gets acquired. So there's, let's say they paid $1,000 up front, there's $500 of deferred revenue at the acquisition date. Rather than just saying, well, I'm going to roll that $500 forward and set that up in my opening balance sheet as a liability assumed, the FASB said, no, we need you to measure that at fair value, the fair value of that liability. And the fair value of the liability for deferred revenue, has its own has its own valuation theory view of the world that says, what are the costs that I have to incur related to that at a profit margin, and that's basically the value of my liability. And so it created this, it ticked clients off for two reasons. One, the buyer now has lost revenue. So the liability was $500 when they bought the business. That's what they would have recognized in revenue had there not been an acquisition. Now it's probably knocked down in a lot of cases to 20 cents on the dollar in a lot of cases. So now my $500 of future revenue becomes $100. So I've now just lost $400 in revenue. And I now have to pay a valuation professional to tell me how much revenue I've lost as part of my accounting for the transaction. So this has been the law of the land for the last 20 years. And so, and as a result, what's proliferated was a lot of non-GAAP disclosures by public companies that were acquisitive that said, here's my revenue, and then they would have pro forma revenue to say, this is what revenue would have been had I not been applying GAAP and have to write off all of this deferred revenue, and had I basically been able to carry this forward. And the SEC got all bent out of shape because they don't like pro forma revenues. But a lot of investors said, well, yeah, you don't like pro forma revenues, but I can't. It creates this discontinuity when I'm trying to look at trends, because now revenues like this, it falls off a cliff and then it jumps back, and that doesn't, as we're evaluating trends, doesn't make a lot of sense. The FASB said, oh, since the investors are telling us that they don't like this accounting, now we'll change it back to the sort of the way it was, which is basically whatever your deferred revenue balance is, if you've been applying 606 correctly all along, if the business that acquires you, or if you acquire a business, the deferred revenue in the opening balance sheet is going to equal what it was that the target had. And so no more deferred revenue haircuts through fair value accounting is kind of the punchline of all of this. And so that's a pretty significant shift for a lot of companies that were active in this industry that had dealt with those write-offs. But it only applies to revenue recognition. It doesn't apply if you're a real estate company and you acquire a company that leases real estate and has prepaid rent as a liability on its books. Too bad. That has to go through a fair value measurement. So it's still a narrow change, but it's one that will provide some benefit to a class of companies. Not effective until 1/1/23, but early adoptions permitted for acquisitions that are happening now. Next one, again, for companies that are applying 842, private companies, there is one of the challenges in adoption under the new standard is because now all leases go on balance sheet, and they need to be recorded, the lease liability needs to be recorded at present value. The present value, the next question is, well, what interest rate do I use? And 842 says I use the discount rate based on what I would borrow to buy the asset on a secured basis, is basically what it says. Well, that means I got to go figure out an interest rate for hardware, computer hardware, automobiles, real estate. All of those different asset classes are going to have different interest rates. And my own credit, and I have to think about not only that, but even if I buy something on a secured basis, the borrower or the lender is still going to think about my own credit worthiness as they go and evaluate the rate. And it's created this big pain for public companies, and we now have valuation specialists that are often getting engaged by public companies to satisfy their auditor requirements to determine an interest rate to put a liability on the balance sheet. So a lot of frustration with that. So there is an expedient for private companies that basically says when you as a private company will have the option, if you elect, to use the risk-free interest rate rather than, so basically, LIBOR or Treasury rate rather, use a Treasury rate rather than, just, figure out, if you've got a 7-year lease, figure out what the 5-year is, figure out what the 10-year is, interpolate the difference, and move on and basically trying to simplify the exercise. Now, the flip side of that is the liability will be much larger, obviously, because you're using a much smaller interest rate to discount, but it does simplify the process. Again, if you do go public, that needs to be undone, and you will have to go and evaluate what the full 842 interest rate requirement would have been But for private companies, it simplifies the exercise considerably. This last one is it is a year-end issue for a lot of companies that are preparing your financials. It's effective for 1/1/22 for disclosures, but because it's a pending accounting requirement, you need to consider it as part of your pending accounting policies when you make your year-end disclosures. But the idea here is that there is no gap that applies in U.S. GAAP. There is no guidance that tells you how to account for government assistance. So whether that's a grant, primarily grants or other state incentives that are not income tax based, that are not contingent on taxable income, those are governed by ASC 740. Once you get outside of that, if you think about a forgivable PPP loan as an example, there's no guidance that existed that told companies how to account for it. And so that's why KPMG and other firms created very lengthy CARES Act manuals effectively to walk through the different accounting policies and treatments that you could apply, because in the absence of guidance, there's a lot of different practices that have emerged to deal with those types of things. So because of that, and because there is no guidance that tells a company if they've received government assistance that you need to disclose that fact, a lot of investors, particularly after the CARES Act came out, have said we need better visibility into where expenses have been reduced by, not artificially, but expenses have been reduced by government incentives, such that they're not paying full freight, and likely at some point that incentive might go away. We need better insight into that. Or where expenses were reduced due to the CARES Act or some other similar provision, or where labor costs are going to be lower for the next 5 years because they relocated their headquarters from California to Texas, and the city of Frisco offered them $1 million package so long as they maintain a certain number of employees for the next 5 years. So as a result, there is a new disclosure requirement that will apply in 2022 that basically says if you've received government assistance, you need to disclose the type of transaction, what government assistance did you receive, and then what accounting policy did you use? Because in the absence of any guidance, there are multiple policies that companies use. A lot of companies default to, there's an IFRS standard that applies to government grants, IAS 20. A lot of companies look to that guidance when they're evaluating the accounting for these types of grants, because there is nothing or very little guidance in US GAAP. So what policy did you use? A lot of times if it's a grant to cover a current year expense, you're just going to net it against the expense. Maybe if I construct a new headquarters in this city, I'm going to get $1 million grant from the government. In that case, a lot of companies will either net the $1 million against the cost of the PP&E, or they'll set up some deferred credit that they'll amortize against the depreciation expense. There's different policies. You need to disclose the transaction, the policy, where is that hitting in the P&L, so that if somebody said, I want to be able to add back the benefit so I know kind of what a run rate looks like, they're able to do that. And then terms and conditions of the transaction, because a lot of times, basically a lot of policies are, as long as I expect to meet the conditions, like my example, if I relocate to the city of Frisco, I get $1 million incentive, and so long as I maintain 100 employees over a 5-year period. And in a lot of cases, what will happen is there's going to be a clawback that says, if I don't maintain 100 employees, I'm going to owe back some amount of money, but the clawback reduces each year. So maybe after year 1, I only owe $800,000 back. After year 2, $600,000. You need to disclose any strings that are attached, whether you expect to meet them or not. That needs to be disclosed as well. And so, there are obviously a lot of government incentives and programs that exist for companies of all stripes. So this is the first real comprehensive again, there's no accounting change, there's no accounting requirement. That may be something the FASB looks at, is to have a policy that applies to the accounting, but this is the first step in that direction to require disclosure around there. What time is it? Thank you. All right, so I got about 5 minutes. So as I said, I will hit this quickly, and then I will dodge the tomatoes that come at me. Again, but it's always good to go after the tax guys when there's a Democrat in office, because they're the ones that have to give the really bad news. But ESG, not here to debate whether it's good or bad, it is just here. And so, environmental social governance, as a starting point, it is very clear that, the SEC is a political body. A majority of the commissioners are appointed by the president, and so the president has a particular focus on climate, and as a result, the SEC has a particular focus on ESG disclosures, somewhat with an emphasis on the E, but really across the board. It's human capital, it's environmental, cybersecurity. Those are all things that they're laser focused on. And so, what is the SEC doing? One, they're making it harder for companies to, it used to be that if a shareholder wanted to put a resolution in front of shareholders, that they had a bar to reach, and the SEC could basically say, they could provide no action relief to a company to say, we're not going to put that on our agenda, and put it to a vote. They have increased the bar to do that for ESG type proposals. And so it's a higher hurdle. If it relates to an environmental, social, or governance matter, it's a higher hurdle to get the SEC to say no action to provide that relief than it had been historically. They've issued a comment, an illustrative comment letter that companies are receiving or could expect to receive around questions around how they're dealing with climate-related risks as it relates to the financial statements or other disclosures in their SEC filings. And we are expecting in early 22 that the SEC will provide proposals on required disclosures around climate risk, human capital, and cybersecurity. There was a disclosure required on human capital that was effective last year. It was very loosey-goosey. There was not a lot of teeth to it. It was just basically talk about how human capital is important to your company, human capital affects your company, et cetera. So companies' disclosures were widely varied, and I expect the SEC to provide more rigor around that disclosure and more requirements attached to it. International development, so the next question that we're starting to get is, how are people going to score keep ESG? So a high number of companies, as I'll show in the next slide, 35% or 95% of S&P 500 companies report some level of ESG information, but there is no centralized or agreed upon scorekeeping mechanism, and there's even fewer assurance requirements. There's no audit requirements, et cetera. So diversity in practice, exists across the board in terms of what should be disclosed, how should we scorekeep, the various metrics, et cetera, et cetera. So there's starting to be more. They're moving. There is an international body, the International Sustainability Standards Board, that's basically a offshoot of the IASB that internationally will likely, that is trying to be kind of the look-to standard setter around sustainability from a global perspective. Just like in the US, we didn't necessarily move to looking to the IASB for our accounting standards, to be determined whether we'll do that for our sustainability standards, but in the absence of anything else, it's going to be a proxy that companies on a voluntary basis may look to as they try to do their own ESG standards and reporting. And then the last part, the role of auditors is starting to increase, but more internationally than in the US. Only 6% of S&P 500 companies did they have assurance provided by a public accounting firm, versus 35% of the Russell 1000 had an independent party. So again, internationally, there's more of a, kind of an independent assurance element that is being provided. It's in its infancy in the US, 6% of the S&P 500, so 30 companies, but it is kind of the next frontier that investors may start looking to, is getting a third party to attest to some level of reporting, because in the absence of it, we do have a lot of reporting on ESG type information, but because there's no common language and because there's no common testing of it, investors are still trying to digest what all of the information means. So those are kind of the areas to be looking to, is more disclosure requirements from an SEC perspective. That'll be outside the financial statements. It's not GAAP. So they'll be in your MD&A type sections, your business section, et cetera. And then as companies start formalizing their ESG programs, they're going to be looking to this International Sustainability Standards Board or another competitor for guidance on how to scorekeep. And there's likely going to start to be a shift towards bringing in some level of auditor to provide that assurance. But again, that's probably a 3 to 5 year notion rather than a 2022 notion. But that's kind of where things are headed. With that, any questions? I know we're right up against time. Any questions, comments? Excellent. Really appreciate everybody's time. And look forward to networking in the happy hour. Thank you.